Okay, so picture this. The market's down 25%. Everywhere you turn, there's bad news. Things don't look good. You can't go to your phone. You can't turn on the news. Everything's red. You're super panicked. And your money, your income in retirement is coming out of your portfolio. How do you feel?
A lot of that depends on how you're invested.
Yeah.
Even no matter how you're invested, how do you feel?
Oh, you feel terrible.
Panic.
Yes.
Yeah, panic.
Sell.
Yeah.
Or just what is going on.
Right. What should I do?
Yeah. The panic is real.
Even when, obviously it's no secret we love dividends, but even our own clients and I mean, me personally, I understand exactly how it works,
conversations.
And when I see so much red, it is so difficult to step back and go, it's okay. Actually, it's good. Like a dividend investor loves bear markets, but it's still terrifying.
Yes.
Right.
Yep. No one likes to open up their account and see less than what they saw the days prior. Ever. Yes.
So the show about today is what actually happens to your income as a dividend investor. Actually, we're going to look at both sides. As I was thinking about this, I wrote this really from a dividend perspective, dividends and bear markets, but I also want to address what happens if you're not in dividends. Because not everybody that's watching this show is going to have dividends.
Sure.
So we're definitely going to talk about that. But I also want to very quickly at the same time as we go through this, talk about what if you're in mutual funds? What if you're just taking money out of your 401k? What's going to happen to those scenarios? All right. So let's talk about that. The market's down 25% and your money's coming out of your portfolio. So we've got money coming out of your dividends and you've got money coming out of mutual funds because that's what the vast majority of everybody else has, right? All right.
Potentially bonds.
What's that?
Possibly bonds.
Or some bonds.
Right.
Yeah, all kinds of stuff.
Yep.
Right? You can have CDs, you can have cash. So psychologically, we're all nervous. We just talked about that. Things are bad. We're bad right along. Even when you know it's right, you're still nervous.
Yep.
Right? What about the mutual fund investor? What's the reality there?
Well, if you need the income and your account values have dropped, now you're selling. And you're selling shares. Like anytime you need income from a mutual fund, you have to sell. So now you've just taken that 25% and compounded it to whatever you're having to pull out. That's another 5%. Or because it's depressed, right? Like you've shrunk 100,000 to 75,000, but you need 25,000. Well, now you've made it half of what you started with instead of 25%. So you kind of end up in this, I think the term's like the death spiral. They can be compounded and kind of exacerbated in those times when the market's down.
Yeah, I think the market volatility can wreak havoc on your own psyche, your emotions, obviously your portfolio. The reality is, we can do math all day long, and I can show you how mathematically you can have a positive rate of return, but your portfolio can be underwater. If you have a portfolio that makes 50% in a year, you're up 50. The next year, you lose 50 of that top value. You're actually already below what you started with. So you had 500,000, you're at 750. Now you're at 375,000 because half of 750 is 375. You're $125,000 below where you started, and mathematically, you're at zero.
Right.
If you went up 50, down 50, you're at zero, but you're $125,000 below where you started. And here's the crazy thing. At 375, if you gained a 30% return, you're at, 480 some thousand.
Still not back to the
You're
start.
showing a 30% growth.
Average rate.
10% average, 30% growth.
Return.
And you're like 12,000, 13,000 below where you started. But mathematically, you're like killing it.
Like when you have to sell something to go get the money, it's gone forever. It's not coming back.
That's the crazy thing about the mutual fund, the ETF kind of a retirement plan, is it only succeeds if you're growing more than you're taking money out.
That's right.
If at any point you're taking out more than what your account values are growing, you start getting in real trouble.
Yeah, and if you have the huge drops, like a COVID, and you're the million drops to 670,000, real story, right? And then you have to sell to get that 4 to 5% that you're living on.
Yep.
That's you're moving down and you're moving down, and it's
That's
not
a
to create
scary
that
place to
fear,
be.
but it is, and it's scary, and You don't know when to get out. And do you realize the loss? Is it going to come back? It's all the questions. You have a lot of people, that come in with this average rate of return. And when you really boil it down and show them year by year, that average rate of return can be quite it can hurt you.
You have two methodologies. And I think the rate of return is a bad one for an advisor to tout. Because rate of return can be very deceptive, which I just gave the example.
That's the word I was looking for.
And I don't think they're meaning to do that.
No.
But you can actually have a really strong rate of return and lose your client money.
Right.
And then you're like, oh, look at my rate of return. We've averaged 10%, but our average clients lost money. But hey, we're up 10%.
Right.
And that's why people come in and they're like, my account shows that I should be averaging 10.
Right.
But my dollars aren't saying I'm averaging 10. Yeah. How can that be?
And there's a word that you really need to bring up for this, and it's yield. For our clients, it's dividend payout.
Yep.
Right.
How much money am I actually going to be making on the money I have invested? And the beauty about dividend investments is it works on how many shares you own.
Right.
Right.
So for every share you own, you get a dollar amount back to you. So as long as you don't sell those shares, you got money in the bank. Right. So in that same example where the market, your portfolio goes up 50, down 50, and up whatever, or it just stays, your value might be below, but on the dividend side, as long as you never sold a share, your income is solid.
That's right.
Okay. There's a caveat on that.
Sure.
Right. Are the companies continue to pay? And that's what we're going to get into now, because there's really three types of dividend companies out there. You've got lifters, holders, and cutters. So lifters are those dividend companies that continue. They have just a culture of raising dividends every single year.
Even when it's down.
No matter what.
They find a way.
Even if it's a penny.
That's right. They find a way.
But if you see a company that's been raising its dividend for, 25 years, which is an aristocrat, or you have ones that are raising it for 50, 60 years, or consistently paying or lifting, it's hard to say, well, what happens in this? They've experienced it over the last several decades.
Yes.
I mean, how many times in the last 30 years has the market been wacko? I mean, we had the bubble burst in 2000. We had 08, the bond debacle. We had 2020. We had 2022. We have had a lot of crazy things happen. Right. And through it all, there's companies that have paid despite all of that.
Yeah. Right.
Okay. And then you've had other companies that just hold their ground.
Right.
Right.
So in all these situations, the dividend companies are paying. Whether they're increasing it when the stock's down, they're holding it, or even if they cut it, that doesn't mean they're getting rid of it.
Correct.
That means they might cut it, which we have seen in our own portfolio. I don't care how long or how good you are, you're going to experience all three of these.
Yep.
Hopefully you experience the top two better or
very
more.
Few. Hopefully three comes very, very few and far between.
But we've had some dividends cuts over the years. When you experience a dividend cut, if you can hold your ground and not overreact, the stock has always, if I look back at all the dividend cuts that we've experienced, every single time the stock's rebounded. But our tolerance and our patience,
did we wait long enough?
and you get those clients that are just pounding us. Why do we have this? Why have you not read the news? Yeah. We're reading it every day.
Yes.
That's right.
And we're trying to be patient.
Yep.
We got one of those stocks in our portfolio right now.
Yep. We've been waiting 9 months.
Well, at what point do you do it? And we had a stock that we sold in May that we should not have sold. SQM. It has absolutely rebounded.
Yeah.
And we get pressured. Why are we doing this? What we replaced it with has done very, very well.
Correct.
Right.
Yeah.
So it's not like it was a bad decision. So we shored up our dividend and we had growth. We could have just had growth as well, less secure on the dividend, but that stock's now a barn burner. So you do get all three of these. The good news is on the dividend side, there's a lot of stability.
Right.
Where the market's volatile, our portfolio is volatile, the balances are volatile, but your income, as long as you hold a lot of lifters, a bunch of holders, and maybe one or two cutters. Nobody wants a cutter, but sometimes you can't predict it.
Well, and that's the beauty of dividend payers. And when they have a history like this, you can do the research. And obviously, past performance is not indicative of the future. But like we always try to tell our client, it can be highly predictable.
Right.
And it's like, why? Because X company has been paying and increasing for 62 years.
Yeah.
Right.
Or we've got this bank that's been paying since 1838. Could they? Sure. But there's nothing that is coming out and saying that this should really be a high concern.
And they need us the way we need them. Like if they need us for capital the same way we need them for income. So both sides want it to work.
And they know if they were to cut or make a change to how they're addressing their dividend,
they might lose.
There's going to be an immediate kind of pull, and that tether that we always talk about, that kind of gets snipped. And they need the tether as much as
our commitment to stay with them through those challenging times when they're not willing to stay with us through those challenging times as an investor.
Well, you see, the 401k side of things, where the mutual fund investor, massive volatility, investors are almost propelled to get out because they're scared. I mean, where interest rates are, you can get out of your mutual fund, you can go get some, steady return
cash
with no volatility. You're like, why would I stay here? There's not a whole lot that tethers you to the 401k mutual fund side of things, and fear pulls you out of it. And that's why investors make such bad decisions because there was really no strategy to begin with. On the dividend side of things, like when the market goes crazy, our portfolio tends to lose a lot less.
Right.
That sounds weird. But what I mean by that is dividend stocks do way better when the market's getting crushed.
Because that's where
everybody runs
to get at least some positive growth.
The dividend payers are where the big money moves into. So our portfolio holds its ground, or dividend portfolios hold their ground, and because of the tether, nobody wants to sell. They're like, I need the income. I'm not going to get out of it.
As long as you're paying me, I'm here.
and even compound that, the goodness of that is when the market's volatile or portfolio is volatile, then you rebalance. Now you're buying so many things on sale because there's going to be a portion of your portfolio, even though the market's crazy, is still made positive rates of return. And there's going to be other parts of the portfolio, just because the tide went out, they're going to be down. When those prices go down, their yield goes up, even though it's a steady dollar percentage. Yes. So when you're selling the high stock and you're buying into the low stock, you're compounding your yield.
That's right.
That means your clients are getting more, the investors are getting more income just by rebalancing in a bad time. Sorry, in a really good time, but a depressed market.
Yeah, a scary time.
A scary time. So in dividend investing, it's hard to think this way.
Right.
But it's like
no one else talks about it.
But it's golden opportunity to make more money by just reshuffling the deck at the time where you just want to stop the bleeding. But the bleeding isn't income bleeding. It's value.
Yes.
And your value is getting, going crazy. Our clients can look back over histories. Dividend investor can look back over histories. As long as you have a rock solid portfolio, you can weather crazy storms and you can amplify your income moving forward. The scariest trade I think I ever did.
Just going to bring this up.
Was May.
Because I remember we took about 18 walks in one day.
Man.
Before you did that.
I mean, I was afraid my skin was going to melt because I was so afraid of the pandemic and COVID. And I'm like, have you seen what's out there? Like, there's so much gold, like these strong companies.
Oh, Exxon got up to like a 10%
it was
yield.
Crazy, Exxon.
Yeah.
And I was like, I'm going to place trade. And it was like May 5th or whatever it was. And this was like the bottom of the market. This was hard. And I remember like, we're talking.
We remember too.
Yeah, it's not just a few pennies. Like there's a lot of money. And I remember, man, looking back, that was probably the most successful trade in company history.
Yeah, when we look at client snapshots, they did more for their income coming into 21.
Yes.
Our average client, I think, grew 15 to 22% in income in 1 year in COVID because of some of the trades we made. And it wasn't, I'm not talking value. I'm talking income growth in a single year. And talk about inflation protection. Like, we didn't even change a whole lot of the stocks. We just reshuffled.
Yep.
So when you see things get red, that's a golden opportunity to take advantage of a very simple thing called rebalancing.
Mm-hmm. Yeah.
Where if you rebalance and you're in mutual funds, and what is that going to do? Just compound your fear.
Well, and not to exaggerate that whole situation, at that same time that you were doing that, people were getting out of mutual funds when just say they were like 23% down. Now, granted, they got out before they were 37% down, but then they didn't get back up until that after the big climb that happened so quickly. So even if you look at the comparison to what you did, which was very hard, but it made a whole lot of sense. But the execution of being able to do that, your confidence was higher because of that income the whole way.
Yeah.
Whereas as you're watching the drop, you're like, when do I get out? When do I get out? And then you stay out and you miss that climb back up. And that as quickly as you went up, the other people went down on a long-term scale because they just missed those 2 days that who would have expected. Whereas if you're in the whole time, you didn't miss that stuff. So if you're in that mutual fund, you miss it.
Yeah,
completely.
one of my favorite quotes from Ramsey is, on a roller coaster, the only people who get hurt are the people who jump off. So he's like, you have to stay on the roller coaster. You have to keep riding the ride.
Yep.
Because if you jump off at the wrong times, that's whenever you get injured.
So we have a lot of real estate investors as clients. A lot.
Oh, yeah.
And I can't tell you how many times I've ever had a real estate investor in my office that has ever talked about a depressed value of their real estate. All they talk about is the income that they make,
right,
the loan to value that they have, the strategy of how they're going to generate income. One of the things that never comes up is when they come in and they're like, hey, I've got these 9 properties and this one right here. It has just done nothing but lose me money. The conversation I've never had.
Right, that's
ever.
true.
They have never looked at a property. They go, hey, I got to figure out a way to make more money out of this.
Right. Yes.
But it's never about the current value. Actually, I've never even seen a real estate investor come in that has their estimated current
actually has their value on.
They don't even look at
right.
it.
No,
Right.
They're not. They're
And yet,
looking at the
real
income.
estate is one of the most successful asset classes ever.
Because they look at it the right way.
Because
Right.
they look at it completely different.
The real estate investor.
And yet, when
looks
you're looking at a dividend portfolio or another type of portfolio, you almost have to have that same logic.
Right.
What are you generating from your position? Are you making positive cash flow? There's no real debt, but if you could have debt on stocks, depending on
But it's what are you making on what you've actually invested?
Correct.
Not what it's
Right.
ballooned to in value, but what have you actually put in?
And what are you making on a
What does it
quarterly
make-
basis, yearly
Correct.
basis of
Yes.
income without having to sell any of it? No real estate owner that I know is like, hey, I'm going to sell a couple of shingles today. I got to pay my bills.
That's right.
Right.
I got to sell the front door. They're all
Anybody
they're
need
doing,
grass from the backyard?
they're getting rent, and that's what a dividend investor is. They're getting rent.
Yes.
They're getting paid by the company to hold those shares, and then the best thing is, how do I get more of those shares? And that's when you shuffle the deck when things get scary. So
Yeah, when the housing market goes down, you look at maybe taking one that's grown really well
Take
and
some-
go buy 2.
yeah.
But can you imagine that instead they were just, every time the housing market went down, they just sold?
Sold all of them.
They were just,
Oh,
we're down
never mind.
20%.
Right.
I'm selling.
Yeah.
And just
Scared to
lose
death.
all the income.
No real estate investor
No,
ever.
you're like, that doesn't
They're like, how do I buy more? I'm going to leverage my house.
Yes. Right. Yeah, that's when they'll take out the debt is to go buy more.
Yeah, that's the smarter investor.
Right.
Okay, let's land this plane.
Yep.
Because I feel like there's a lot more we can talk about. Because this is one of those
Broken
topics.
into 3 or 4.
So, and what last thoughts you got?
Look at how much you're actually taking home. Look at the paycheck. Stop looking so much about the actual account value. It's important, yes, but really you need to be concerned about what you're actually taking home, your income.
I would say that. And I always bring up the word emotion. There's a lot of different investment types out there. But at the end of the day, what do you feel comfortable doing? What can you stay in and truly execute? Not just growth, but if you can get the growth in the income, you're more apt to be able to stay in and not jump off. I like that one. I didn't hear that one before. Not jump off the roller coaster during challenging times. So,
Yeah, and I would just say, pause when you panic. Like, just take a breath, evaluate what's really going on before you press sell.
Wait a day.
oh, yeah.
It's a 24-hour rule.
That's it.
Right.
So mine would be, it's natural. When you have these emotions to want to sell, even dividend investors, even our clients, my advice would be, stop asking the question and stop focusing so much on rate of return and start focusing more on yield. What you're actually making on your money. What are you getting without selling any principal? And if you are panicked and the market's down, call your advisor. Call us. Let's get to the bottom of where the emotion's coming from. It's probably fear of the fact that you are having to sell principal if you are, or a lack of knowledge for our own clients of what's really happening in their own portfolio.
It usually takes a cycle or two to like fully believe it and trust that like,
Yeah, that's
okay,
true.
what's actually,
Or-
what we've been saying is true.
Or even if there's been lots of cycles, but now the reality is caught up again, and you just need a little bit more reassurance and need to look at the statements. Because the beauty about dividends is all you have to do is really look at your statements and understand how they work. And sometimes we all need reminders of that. You know, as a human being, you know, we live in a super stressful world, and there are times where I go through things and I'm like, yeah, I'm strong. And then something happens and you're like, whoa, I'm not as strong as I thought.
Right.
Well, investors are the same thing. You know, there's times where like, no, I get it. And then something happens, they're like, do I really get it? You know, sit down with your advisor. You know, this is real. They're real life. So God bless. Hope you enjoyed today. Oh, wait.
Dividend kit.
Yeah, I forgot. Go ahead.
No, I was just going to say, if you liked what you've heard, please subscribe. We also have a dividend starter kit. That would be great to kind of help you understand some of these principles. So give us a little note in the comments, and we'll be happy to send that to you.
God bless.